I have been in this business long enough to see the same good ideas grow old and tired. A trading method is born strong, makes money easily, and then, little by little, it stops paying its keep. The market hasn't betrayed you. It has simply moved on. The trouble is, most traders don't move with it. They cling to yesterday's trick like a man hugging driftwood after the tide has already changed. Have you ever noticed how a strategy works best right after you discover it, and worst after you've grown comfortable with it? Strategy decay is nothing mysterious. It's the market reminding you that it owes you nothing. When a method works, it attracts attention. Other traders pile in. The edge thins. The price action that once moved cleanly now hesitates, shakes, and reverses. You still take the same signals, but they no longer carry the same weight. And you sit there wondering what went wrong, don't you? I learned early that the market is not a fixed thing. It breathes, it expands and contracts. Trends run strong, then go dull. Volatility swells, then dries up. A strategy built for fast, emotional markets will starve in quiet ones. A method that thrives on long trends will bleed to death in choppy ranges. Yet the average trader treats a strategy like a religion instead of a tool. Isn't that a strange way to approach a living, changing market? Most traders believe their system stopped working because they personally failed. They blame their discipline, their psychology, their luck. Sometimes that's true. More often, the method itself has gone stale. The market has changed its habits. And the trader, instead of adapting, doubles down on rules that no longer fit the tape. That's when small losses grow larger and confidence quietly erodes. I've always said that prices tell the truth. Charts speak plainly if you listen without hope or fear. When a strategy decays, the tape shows it first. Breakouts fail more often. Follow-through disappears. Winning trades take longer to work, while losing trades hit fast. Have you seen that pattern and ignored it, telling yourself, it's just a rough patch? A man who wants to survive in speculation must keep his eyes open and his opinions loose. The market doesn't care how clever your backtest was. It only cares about today's supply and demand. When your entries no longer line up with real pressure in the market, you are trading memory instead of reality. That is a dangerous habit. There's another part of strategy decay that few like to admit. As traders gain experience, they change. A beginner follows rules because he must. A seasoned trader bends them because he thinks he knows better. Over time, what you call the same strategy is really a softened version of its former self. Stops widen. Entries slip. Trades are held longer than planned. Is it any wonder the results change? Money mindset plays its part here. When a strategy works, profits come easily. Confidence grows. Then losses arrive, and the trader starts trading to protect his income instead of to read the market. He avoids good risks because he's afraid of giving back gains, or he overtrades to force the old results back into existence. Either way, the strategy decays not just on the chart, but in the trader's thinking. Wealth in trading has never come from clinging to a single idea forever. It comes from understanding when conditions favor your approach, and when they don't. I made my biggest money by sitting out when the market wasn't suited to my style. Can you sit on your hands when your favorite setup stops working? Or do you feel compelled to trade no matter what? The charts will always offer temptation. There is always a pattern forming, a signal flashing, a reason to get involved. But a professional knows that opportunity is not evenly distributed. Sometimes the best trade is no trade at all. Strategy decay often reveals itself in impatience. You trade more to make up for what the market is no longer giving freely. Adaptation does not mean constantly inventing new indicators or chasing the latest trick. It means returning to first principles. Is the market trending or ranging? Is volume expanding or drying up? Are leaders acting strong or weak? When you answer those questions honestly, you often see why your old method is struggling, and once you see it, you can step aside or adjust size, expectations, and timing. Many traders confuse consistency with rigidity. They believe that changing anything is a sign of weakness. I believe the opposite. A man who cannot change his mind in the face of new facts is dangerous to his own account. The market rewards flexibility, not stubbornness. Isn't that true in every other business as well? Strategy decay is also a lesson in humility. No method is permanent. No edge lasts forever. The moment you believe you have found something that cannot fail, the market prepares to teach you otherwise. This is not cruelty. It is simply the nature of speculation. The market tests every assumption, sooner or later. If you want to build real wealth from trading, you must think in cycles. Cycles of markets, cycles of strategies, cycles of your own performance. There will be times when your approach fits perfectly and money comes with ease. There will be other times when preservation matters more than profit. Can you recognize which phase you're in, or do you treat every day like it's the same? A trader who survives learns to listen when the market grows quiet around his ideas. He reduces risk. He studies. He waits. He does not argue with price. Strategy decay is not a failure. It's a signal. A message telling you that conditions have shifted and that your job is to shift with them. What once worked, because few understood it, fails once too many depend on it. I've seen this truth play out more times than I can count, and every time it catches the crowd by surprise. A trading idea is born in obscurity. It works quietly, almost effortlessly, because it lines up with how money is really moving, not how people think it should move. At first, only a handful see it. They act without noise, without urgency, and the market rewards them. But success has a way of attracting attention, doesn't it? The moment an idea becomes popular, it begins to change its nature. Traders talk about it. They teach it. They package it into rules and indicators and neat little boxes. What was once a flexible observation of price becomes a rigid formula, and the market, which is always a step ahead of the crowd, adjusts. Have you ever noticed how a setup looks perfect on old charts but feels slippery in real time? Markets move on expectations. When too many traders expect the same outcome from the same signal, that outcome loses its power. Buying pressure arrives too early. Selling pressure appears before the move has time to mature. The clean follow-through you once relied on turns into hesitation and whipsaws. And traders, instead of questioning the crowding of the idea, blame execution, spreads, or bad luck. I learned long ago that the market punishes certainty. When few understand a strategy, they trade it cautiously. They wait for confirmation. They size properly. But when many believe in it, they rush. They anticipate instead of reacting. They over-leverage because the past has made them comfortable. Isn't it strange how confidence, when shared too widely, becomes weakness? An edge exists because of imbalance. Imbalance of knowledge, of patience, of temperament. When that imbalance disappears, so does the edge. A widely known strategy becomes a self-fulfilling trap. Traders buy because the rules say buy, not because demand is actually present. When the buying dries up, price falls back on them, and they are left wondering why the market feels unfair. Charts don't stop working because patterns disappear. They stop working because behavior changes. When everyone recognizes the same pattern, they act at the same time. That action alters the very structure that made the pattern profitable in the first place. It's like too many people leaning on the same door. Eventually, it doesn't open the way it used to. There's a dangerous comfort in trading what everyone else trades. It feels safe. It feels validated. If the trade fails, you're not alone. But safety and profit are rarely found in the same place in speculation. The best trades I ever made felt uncomfortable because they were not crowded. They required patience and conviction, not confirmation from the masses. Can you stand being early and alone, or do you need agreement before you act? This is where money mindset matters. Traders who depend on popular strategies often depend on steady income from the market. When results fade, they push harder instead of stepping back. They trade more size, take more signals, and lower their standards. They are no longer trading price. They are trading fear of missing out and fear of falling behind. Wealth in trading has always favored those who observe rather than imitate. The market leaves clues long before a strategy becomes common knowledge. Subtle changes in volume. Leadership shifting from one group to another. Quiet accumulation where no one is looking. By the time a method is widely taught, those clues have already been acted upon by stronger hands. There is nothing wrong with learning from others, but there is danger in believing that what worked for many yesterday must work for you tomorrow. The market is a forward-looking machine. It discounts the obvious. It feeds on predictable behavior. When too many depend on the same edge, that edge becomes the market's fuel, not the trader's advantage. A professional understands that popularity is a warning sign. When a setup becomes easy to spot and easy to explain, its days are numbered. The crowd trades outcomes, the operator trades conditions. He asks not whether a strategy used to work, but whether the forces that made it work are still present. Do buyers still have urgency, or are they merely hopeful? I've seen traders cling to famous methods long after the market has outgrown them. They adjust parameters, add filters, and invent explanations to protect their belief. All the while, price keeps telling a simpler story. The opportunity has moved elsewhere. Capital has shifted, and the trader, loyal to an idea instead of the tape, pays for that loyalty. The real skill is not finding a winning strategy. It's knowing when its time has passed. That knowledge comes from watching price without attachment. From accepting that no edge belongs to you forever. From understanding that success invites competition, and competition erodes advantage. This is not pessimism, it's realism. When few understand a strategy, it reflects genuine insight. When many depend on it, it reflects habit, and habit is easy for the market to exploit. The trader who lasts is the one who keeps asking why something works, not just whether it works. Because the moment you stop asking why, you stop adapting. Markets evolve faster than traders' beliefs, and that gap is where losses live. I've watched that gap widen again and again, usually without much noise. The market changes its rhythm quietly, while traders keep dancing to the old tune. They don't notice at first. Why would they? The rules that once paid them still look right on paper, still look respectable on past charts. But the tape no longer responds the same way. Have you ever felt that uneasy moment when your setup triggers perfectly, yet something feels off? Belief is a powerful thing in speculation. A trader builds belief through repetition. He sees a pattern work often enough that it becomes familiar, and familiarity turns into trust. Trust turns into conviction. Conviction hardens into belief, and belief once formed resists change. The market, meanwhile, has no such loyalty. It shifts as capital shifts, as conditions shift, as human behavior shifts. It does not wait for your beliefs to catch up. I learned early that the market rewards observation, not memory. A trader trading from belief is trading the past. A trader trading from observation is trading the present. The difference between the two is subtle, but it shows up in results very quickly. Belief says, this should work. Observation asks, is it working right now? Which one do you think keeps a trader solvent? The market evolves because people evolve. Fear changes shape. Greed changes speed. Technology shortens reaction time. Information spreads faster. What once took days now takes minutes. What once required skill now requires patience. A strategy built in one environment cannot survive unchanged in another. Yet traders cling to it because letting go feels like admitting they were wrong. Losses often don't come from bad analysis. They come from delayed acceptance. The trader sees the signs but explains them away. Breakouts fail more often, but he tells himself it's just noise. Trends shorten, but he says volatility will come back. He holds on because belief feels safer than uncertainty. Isn't it strange how certainty can be the most expensive comfort in trading? Markets don't announce their evolution. They whisper it. Volume dries up where it used to surge. Leaders stop acting like leaders. Reactions grow muted. The trader who is flexible hears these whispers early. The trader who is rigid needs a string of losses to hear them at all. By then, the lesson costs far more than it should. Money mindset plays a cruel role here. When a trader depends on the market for income, belief becomes emotional. He needs his strategy to work. He needs the market to behave the way it used to. That need clouds judgment. Instead of reducing risk, he presses harder. Instead of adapting, he hopes. Hope has never been a sound trading plan. The market evolves because capital is always searching for efficiency. When too many exploit the same inefficiency, it disappears. When that happens, price action changes character. It no longer rewards the obvious. It punishes predictability. Traders who don't adjust feel targeted, as if the market is moving against them personally. But the truth is simpler. They are standing still while the ground moves beneath them. I've always believed that charts are a reflection of mass psychology. When psychology shifts, charts must change with it. If you trade patterns without understanding the psychology behind them, you're trading shapes, not behavior. And shapes alone cannot tell you when a belief has outlived its usefulness. A trader who lasts learns to question himself before the market forces him to. He asks whether his losses are random or structural, whether the market is merely testing him or truly transforming. He does not assume the market is wrong simply because it disagrees with him. That humility is expensive to learn and cheap to maintain. Beliefs are useful only when they are temporary. They should guide you, not chain you. The moment a belief prevents you from seeing what price is actually doing, it becomes dangerous. Many traders fail not because they lack intelligence, but because they have too much faith in what once worked. Wealth in trading comes from staying aligned with the present. Not the last bull run, not the last volatility cycle, not the last strategy that made you feel smart. The present, that requires constant recalibration. Not constant trading, but constant awareness. Are you trading what you see, or what you expect to see? Markets reward those who adapt early and punish those who adapt late. The gap between evolution and belief is small at first, barely noticeable. Then it widens. Losses increase. Confidence erodes. The trader feels confused, even betrayed. But the signs were there all along. The market was moving forward, and the trader was anchored to an idea. The hardest adjustment is not technical. It is mental. Letting go of a belief feels like losing part of your identity, especially if that belief once made you money. But the market doesn't care who you used to be. It only cares what you do next. An edge weakens the moment you trade it from habit instead of observation. That's a lesson the market teaches gently at first, then brutally if you refuse to listen. Habit feels efficient. It feels professional. You wake up, scan the charts, wait for the same signals, place the same orders. Everything feels under control. But control in trading is often an illusion, isn't it? Habit forms because something once worked. You didn't invent the habit out of laziness. You earned it through experience. You saw the same behavior repeat often enough that your mind stopped questioning it. And questioning takes energy. Observation takes effort. Habit is easy. The danger is that the market never promises to repeat itself just because you've grown used to it. When you trade from observation, you are alert. You are present. You're asking what price is doing right now, not what it usually does. When you trade from habit, you're filling in the blanks before the market finishes its sentence. You see what you expect to see. You enter because it's time to enter, not because the conditions demand it. Have you ever taken a trade and realized afterward that you never truly read the tape? Habit dulls the senses. The chart looks familiar, so you stop studying it closely. You recognize the pattern and stop measuring its quality. Volume is weaker, but you ignore it. Structure is sloppy, but you take the trade anyway. After all, this setup has worked 100 times before. That's when the edge starts slipping away quietly. The market rewards attention. It punishes autopilot. The professional difference is not intelligence, but awareness. Two traders can trade the same strategy. One adapts it daily through observation. The other executes it mechanically through habit. Over time, their results separate. One survives. The other wonders why his numbers no longer add up. Habit also affects risk. When you're observing, you sense when conditions are fragile. You size down. You wait for confirmation. When you're habitual, you size up because it feels safe. You've done it before. You trust the process more than the price. Isn't it strange how confidence grows just as conditions quietly deteriorate? Markets are subtle. They don't flip a switch from good to bad. They slide. A little less follow through here. A few more false moves there. Nothing dramatic. Enough to punish inattentiveness. Not enough to scare you away. Habit keeps you involved, long after observation would have told you to pause. I've always believed that the tape speaks differently every day. Same symbols, same charts, different tone. Some days price moves with urgency. Other days it drifts without conviction. Habit treats all days the same. Observation does not. That distinction is where edges are protected or destroyed. Money mindset plays its role again. Habit gives a sense of stability. It feels like work. You're doing your job. Observation feels uncertain. It requires judgment. Judgment can be wrong. Habit shields the ego. If the trade fails, you followed the rules. Observation puts responsibility back on you. Are you willing to accept that weight? Many traders confuse discipline with routine. Discipline is staying aligned with the market. Routine is repeating actions regardless of alignment. One creates longevity. The other creates slow decay. The trader who lasts breaks routine often, but never discipline. He watches first, acts second. Habit also shortens patience. When you expect trades at certain times or levels, waiting feels uncomfortable. You want action because action is familiar. Observation allows waiting because it has no schedule. It enters only when price earns it. That difference alone saves more capital than most indicators ever will. An edge is not a static thing. It's a relationship between your behavior and the market's behavior. When your behavior stops responding to changes, the relationship breaks down. You're still doing your part, but the market has moved on, and the market will not meet you halfway. The longer you trade, the more seductive habit becomes. Experience creates shortcuts. Shortcuts save time, but in trading, shortcuts often bypass critical information. The experienced trader must fight complacency harder than the beginner fights fear. Fear keeps you alert. Complacency puts you to sleep. I've seen traders lose money for months using a strategy that still technically worked. The problem wasn't the rules. It was the blindness. They stopped noticing when the market was giving and when it was merely tolerating them. They treated every signal as equal. The market never does. Observation demands humility. You must admit that today may not behave like yesterday. Habit demands nothing. It assumes continuity. That assumption is costly. Markets change character without warning. The only warning is in the details most habitual traders stop seeing. Wealth in trading comes from preserving edges, not exhausting them. When you trade habitually, you extract from the market without replenishing understanding. Observation replenishes. It keeps your edge sharp by keeping your mind engaged. The moment you feel bored while trading, your edge is already in danger. There is nothing wrong with having a framework, but the framework must breathe. It must bend. It must respond. Habit turns frameworks into cages. Observation turns them into tools. The difference is subtle, but the outcome is not. The market never breaks your strategy. You break it by refusing to adjust. That truth is uncomfortable, which is why most traders avoid it. It's easier to believe the market has changed unfairly than to accept that you didn't change with it. I've watched traders argue with price as if price were obligated to respect their rules. But the market has no memory, no loyalty, and no obligation to any method, no matter how well it worked before. Have you ever noticed how quickly frustration replaces curiosity when a strategy stops paying? A strategy is only a snapshot of understanding taken at a specific moment in time. It reflects how the market behaved then, not how it must behave now. When conditions shift, the strategy doesn't fail on its own. It waits, it gives warnings, it shows subtle signs of strain. But the trader keeps executing it mechanically, expecting the same response. That expectation is what breaks the strategy. Most traders don't actually trade strategies. They trade beliefs about strategies. They believe that if the rules are followed precisely, profits must follow. That belief works only as long as the market environment supports it. When it doesn't, discipline turns into stubbornness. Rules become blinders, and instead of adjusting risk or standing aside, the trader pushes harder, convinced that persistence will bend the market back into shape. Has persistence ever forced price to do anything? The market is not a machine that rewards repetition. It's a living auction driven by shifting motives. When volatility changes, liquidity changes. When leadership changes, behavior changes. A strategy built for expansion struggles in contraction. A breakout system suffocates in balance. Yet traders often keep trading the same way because changing feels like admitting defeat. Adjustment doesn't mean abandoning everything at the first loss. It means listening. It means noticing when follow-through weakens, when trades require more time, when stops are hit more frequently without momentum. These are not random events. They are information. The trader who ignores them is not unlucky. He is inattentive. There's a certain pride that grows with experience. A trader starts to identify with his method. It becomes part of who he is. He's a trend trader, a breakout trader, a momentum trader. That identity can be useful, but it can also be limiting. When the market no longer rewards that identity, the trader feels personally challenged. Instead of adapting, he defends. Isn't it strange how personal we make something that was never personal to begin with? Money mindset plays a dangerous role here. When income depends on the market, flexibility feels risky. Standing aside feels like failure. Adjusting size feels like retreat. So the trader keeps trading, even when the edge has thinned, because stopping would force him to confront reality. The market doesn't break the strategy. The trader breaks it by demanding performance where none exists. Charts are honest. They show when price is accepting higher levels and when it is rejecting them. They show urgency and hesitation. But traders often stop reading charts and start reciting them. They recognize patterns without evaluating context. They execute setups without asking whether conditions still favor those setups. That's not strategy. That's routine. A broken strategy often still produces winners. That's what makes it dangerous. Random wins reinforce false confidence. They convince the trader that patience will eventually pay off. Meanwhile, losses accumulate quietly. Drawdowns deepen slowly. The trader keeps believing because belief is easier than reassessment. Adjustment requires humility. It requires admitting that what worked before may no longer work now. That admission feels like weakness, but it is strength. The strongest traders I've known were quick to step aside when conditions shifted. They didn't wait for confirmation from their P&L. They listened to price behavior. The market does not reward effort. It rewards alignment. When your strategy aligns with current conditions, trading feels almost effortless. When it doesn't, every trade feels heavy. Execution feels forced. Confidence feels brittle. Those sensations are signals, not emotions to be ignored. Many traders mistake survival for stagnation. They keep trading the same way because they haven't blown up yet. But survival without growth is just slow decay. Capital erodes not only through losses, but through missed adaptation. The opportunity cost of stubbornness is enormous. Wealth in trading is built by those who remain flexible under pressure. They don't need the market to behave a certain way. They observe how it is behaving and position themselves accordingly. They know when to press and when to protect. They don't marry strategies. They rent them. The market will test every trader's ability to adjust. It does so quietly at first, then loudly if ignored. Those tests are not punishments. They are invitations to evolve. Refusing that invitation is what breaks traders, not the market itself.